Welcome to the WealthKode Blockchain Knowledge Series, and in this episode we'll be talking about Decentralized Finance, commonly referred to as DeFi. Remember to follow and subscribe to our pages for all future episodes being released on a regular basis. And of course, if you'd like us to delve deeper into any of your favourite blockchains, cryptos or digital assets for future episodes, or you have any questions at all, feel free to drop a comment. So let's get started. Decentralized finance, or DeFi, is a rapidly growing movement set to disrupt and disintermediate the world of financial services, providing an alternative ecosystem of lending, borrowing, derivatives trading, insurance, asset management, and exchange platforms. This DeFi world is being developed using smart contracts on top of distributed blockchain networks like Ethereum. These self-executable agreements are highly composable, meaning they can easily be combined to form the building blocks of a new financial system that is open to anyone without the need to trust a third party. During this video, we'll explore the history of DeFi, how it generally works, which protocols and use cases are the most popular, the risk and rewards on offer, and what the future holds for this emerging industry. First up, what is DeFi? DeFi is a collective term for a range of financial service applications running smart contracts on blockchain networks that allow participants to transfer value and earn yields without intermediaries. The origin of the term DeFi can be traced back to a brainstorming session between Ethereum developers and entrepreneurs in 2018, while discussing what to call the new open finance applications that were being built on the network. As we'll discuss in greater detail further into this video, there are several categories of DeFi applications, though they all share the main characteristics of being open, non-custodial, transparent, and decentralized. Not only does this cut out intermediaries, but it also avoids the formal, bureaucratic, and often costly alternative agreements in traditional finance, opening up a world of new savings, investments, and trading opportunities to anyone. Participants interact with transparent and open source code rather than people, with no forms, personal information, or KYC requirements, retaining control over their funds at all times without a custodian. By building on top of a base layer of decentralized blockchains run by thousands of computer nodes spread across the world and managed by a community of users as decentralized autonomous organizations, DAOs, it's also implausible for DeFi applications to be censored or stopped. DeFi does, of course, require a high degree of personal responsibility and is not without risk, as we'll discover later. But, as a result, the rates and fees paid and earned in the DeFi ecosystem are far more attractive than those available in the closed legacy system, where central authorities extract most of the value. History of DeFi. Although Bitcoin itself is a form of decentralized finance, the protocol that launched what would become known as DeFi was MakerDAO in 2017, an Ethereum-based protocol that allows users to create DAI tokens, a USD-pegged stablecoin. MakerDAO represented one of the first means of both obtaining a loan and accessing a stablecoin without needing a centralized entity. This ability created the foundation for a new, permissionless financial ecosystem, paving the way for first-generation DeFi protocols like Compound that created a market for borrowers to take out loans and lenders to earn interest payments, as well as automated market maker (AMM) platforms like Uniswap that could seamlessly exchange assets without an intermediary. Now, dozens of use cases exist across a plethora of decentralized financial services that are just getting started. How DeFi works. Given the range of protocol use cases available, describing how each type works is beyond the scope of this video. Generally speaking, however, DeFi applications use programmable smart contracts built on a compatible blockchain that executes these agreements transparently and immutably, paid for in gas transaction fees on that network. Most DeFi applications will refer to the term TVL, meaning Total Value Locked. When users deploy funds into a DeFi protocol smart contract, it adds to this TVL and can be used to gauge a dApp's success. Funds aren't being deposited to a platform as they'd be in traditional finance. Rather, the participant is deciding to lock or use them in a smart contract for a particular purpose, retaining control over the funds themselves. To use DeFi protocols, users need to download a compatible web wallet like MetaMask. The wallet can then be connected to the web app of the DeFi application participants wish to use. Users can then interact with the protocol and send tokens into its smart contracts by verifying transactions that will then be broadcast on the blockchain network the app is built on, having paid the corresponding gas fee. The same process can then be followed for other transactions or DeFi applications, whether it be lending assets to earn interest, taking out loans by providing collateral, staking assets for yield farming protocol rewards, earning governance tokens from liquidity mining, swapping tokens on AMM decentralized exchanges or aggregator platforms, accessing stablecoins and minting synthetic assets, taking out insurance, or trading DeFi derivative markets, and so on. The majority of the current DeFi ecosystem has been built out over the Ethereum network, though other blockchains including Binance Smart Chain and Solana, as well as Ethereum Layer 2 scaling solutions like Polygon, are seen as an alternative to often high Ethereum transaction fees. Popular DeFi protocols and use cases. There is a rapidly increasing number of DeFi protocols and use cases emerging, disrupting every corner of traditional finance space. Let's take a look at some of the most popular, robust, and liquid options available. Generating a DeFi stablecoin with MakerDAO. As we already touched upon, MakerDAO was ahead of the curve. Its USD-pegged DAI stablecoin provided the initial breakthrough in DeFi, backing up this digital dollar by locking over-collateralized assets like ETH and WBTC into smart contracts governed by a decentralized autonomous organization of MKR token holders. MakerDAO allowed users to transfer stable value while also retaining the assets used for collateral, deploying stablecoins into further DeFi protocol use cases, and providing a foundation of billions of dollars of stablecoin liquidity on Ethereum and beyond. Lending and borrowing with Aave and Compound. Protocols like Aave and Compound allow users to automate lending and borrowing agreements on Ethereum with no KYC or approval process. Lenders can supply assets to protocol smart contracts for liquidity and earn interest rates at many multiples of those available in the banking industry. In turn, borrowers can borrow tokens from the protocol, such as stablecoins, by locking up sufficient collateral in other assets, such as ETH, to borrow against. The protocol code then enforces that interest is paid by borrowers to reward lenders and that the collateral provided remains sufficient to service a loan. If they fail to keep to the agreement, the provided collateral can be liquidated to settle the loan. As a result, such lending and borrowing protocols generally require over-collateralization to account for the volatility in digital assets, though Aave and others are experimenting with under-collateralized loans by delegating borrowing power to users without collateral, for a fee. Decentralized exchanges like Uniswap and SushiSwap. Non-custodial and permissionless automated market maker platforms like Uniswap and SushiSwap represent some of the most popular DeFi applications today, providing an alternative decentralized exchange framework that does away with the need for traditional order books. Instead, AMMs openly incentivize any users to provide funds to smart contract liquidity pools of token pairs, such as ETH, DAI, with market prices managed by arbitrageurs. Liquidity providers supply an equal value of both pool tokens to create a market and earn a proportional share of the returns from low-cost fixed trading fees earned by these pools, in a process known as yield farming. DeFi protocols like Yearn Finance can then take this to the next level by combining the power of the wider composable DeFi ecosystem to compound gains. Liquidity mining can add further yield opportunities on some platforms by also rewarding users with protocol governance tokens. Traders can then swap tokens with sufficient liquidity without the need for centralized exchanges. DEX aggregators like 1inch take this a step further by combining the liquidity of various AMM protocols into a single platform. And DeFi derivatives protocols like Synthetics can even help create tokenized markets for real-world assets like stocks and commodities. Understanding the risks. By this point, the benefits and rewards of decentralized finance should be apparent, but that's not to say the ecosystem is without risk. DeFi requires far higher personal responsibility than the traditional financial system, where people are used to a central authority bailing them out if something goes wrong. Do your homework and operate on well-established, highly liquid DeFi protocols with simple yield generation strategies, and you can reap the rewards. But there is always a chance you can lose all of your money, so never risk more than you're willing to lose. To give you an idea of some of the risks, let's take a look at the most common issues. While DeFi protocols are inherently open, transparent, decentralized, and non-custodial, you are still allocating those funds to a smart contract. As such, you're exposed to potential bugs, failures, hacks, or exploits in the code where funds can still be lost. It's therefore vital to research DeFi projects and look for smart contract code audits, though DeFi insurance protocols like Nexus can also help mitigate this. Particular care should be taken to avoid protocols with an admin key or other form of privileged access that can leave users vulnerable to rug pulls and exit scams. AMMs also introduce a particular type of risk to DeFi known as impermanent loss. As a result of periods of extreme volatility in crypto markets, this is when the total dollar value of the deposited tokens is at a loss from liquidity provision compared to just holding. It's important to note, however, that liquidity provision is still often profitable, as impermanent loss can be offset by the pool rewards received. Other risks include lack of liquidity in DeFi protocols causing slippage and withdrawal issues, fake tokens, oracle failures where malicious actors exploit the protocol, social engineering, and potential loss of stablecoin pegs. So what's next for DeFi? There's no doubt that DeFi has witnessed rapid growth in a short space of time, reaching over $75 billion in total value locked. But at just 5% of the overall crypto market and a small fraction of traditional finance, there's plenty of room for further disruption. New Layer 1 smart contract blockchain, Ethereum's transition to proof of stake, and the advancement of Layer 2 solutions are all helping to reduce some of the current barriers to entry in terms of fees and bottlenecks. As scalability improves, liquidity on existing DeFi platforms is likely to grow and expand towards a range of applications that have the potential to disintermediate every corner of traditional finance systems. Thanks for tuning into this episode of WealthKode Blockchain Knowledge Series. Stay up to date by subscribing and following our pages for all future episodes. And feel free to comment if you'd like us to delve deeper into any of your favourite blockchains, cryptos, or digital assets in future videos. I'll see you on the next episode.